If you already invest into or just considering dividend stocks, you are in the right place. In this video I'll go over 4 things I usually look for in a good dividend investment. First, look at historic dividend payouts. Companies with a long history of paying dividends, such as 3M, Procter & Gamble, and Coca-Cola, are often considered more reliable dividend investments than companies with a shorter or more inconsistent dividend history. For example, if Company A kept paying dividends at 3.5% yield since 2010 and paid a quarterly dividend of 50 cents per share. This means that if you owned 100 shares of a stock, you would receive $50 in dividend payments every quarter, or $2.600 over 13 years. Second, I look for 5% plus annual growth in dividend yield. Companies often increase dividend yields every year to keep up with stock price and inflation. I would recommend looking into so-called dividend aristocrats. These are S&P 500 companies that for at least 25 years kept paying out and increasing their dividends. For example, let's say that the same company A had consistently increased its dividend yield by 5% per year. If you would have bought the same 100 shares, from in 2010 to 2023, your dividend yield would grow from 3.5% to 5.64% today. And you would have received around $3,276, instead of $2,600, over the exact same period. Consider also reinvesting dividends to buy more shares and leverage the power of compounding. Third, look for below 80% payout ratio. The payout ratio measures the percentage of a company's earnings that are paid out as dividends. The high payout ratio may indicate that a company is paying out most of its earnings as dividends and may not have much room for future dividend growth. Real estate investment trusts are the exception, as they are required to pay out around 90% of their proceeds as dividends. Fourth, look at reasonable debt-to-equity ratio. The debt-to-equity ratio, total liabilities, shareholder equity, is another important factor to consider when assessing a potential dividend investment. This ratio measures a company's financial leverage by comparing its total liabilities to its total shareholder equity. A low debt-to-equity ratio, let's say below 1, may indicate that a company is financially stable and able to meet its obligations. I hope this helps. Let me know what you'd like me to talk about next.